Fears about inflation riling investors yet again today. What looked like a turnaround of about 375 points for a while intraday. We got over 400 points up on the Dow. Then everything went kablooey. Apparently, there's a reassessment going on here with an employment report that came in with almost a Goldilocks read of the economy. Not too strong, not too awful. And a lot of people read into that the fact that we gained 3 to 15,000 jobs and some inflation components in that were advancing, but at not the rate they had been, that maybe we were over the hump here. The Fed might cool it for a while. Long story short, they reassess that. The markets end up down. And for the third straight week, we have a tough week for the markets. By the way, the NASDAQ, which in all those technology stocks, is now in correction territory, which means a fall of 10% or more from highs reached a little more than one about 3.5 weeks ago. Let's get the read from Stanford School of Business lecturer, Professor Dave Dodson, one of the smartest people I know, so he can make sense of this. Professor, good to have you. Well, markets are worried about inflation. Average folks are seeing inflation, minus at the gas pump, better than it was. Not as great as it was, a year or so ago, but you take what you can get. But that seems to be the only little bastion of stability right now. What's going on?
Yeah, I mean, the stock market was crazy today, right? Because it was schizophrenic. At first, they thought it was good news, then they thought it was bad news. My own read on it is this, Neil. I think that as people started to get past the headlines of the job report, they focused on what I think is the most important part of that job report, which is the difference between jobs available and job seekers. And the difference is 2 to 1. And by the way, Neil, historically, that's about a 5% difference. So we're looking at a 200% difference. There is no way that you can have a labor market that has that much of a mismatch and not continue to fuel inflation. And I think people started to focus on that. And the one thing that's brilliant about the jobs report is that it's not like the CPI or the GDP that's a trailing indicator. The jobs report is our single best leading indicator of what's going to happen over the next 100 days.
You know what's interesting about some of the other numbers you were referring to, Professor, is we have another million people who sort of quit the workforce. They think they can do quite well on their own, or they're not part of it. Now, 11 million job openings out there. And that's the pressure right now. In order to sort of tempt them back, wages have to go up, right?
Oh, absolutely. That is the tension that's going to be driving wages up. I don't see how wages can't be driven up. I was talking to a friend of mine. He's got a donut shop, right? He sells chocolate donuts, and he wants to stay open his normal hours. He can't because he just can't get his donut shop staffed. That is what's happening across America right now. And the only way that you're going to get people to come back to work and work more hours and have more staffing is to pay more. And so, Neil, I totally agree with you.
One of the things, too, that's interesting in the employment report itself, Professor, is virtually every sector of the economy still chugging along. Not chugging quite the way it did some months ago, but when you're averaging this type of job growth and you're still seeing wage growth of about, 5.2% or so, that is an inflationary worry and probably reason for the Federal Reserve to stick to its plan to hike rates. Right now, the question is if it's another 3/4 point hike next month, or later this month, I should say, that would be the third such hike in a row. Eventually, that's got to hit these very numbers, doesn't it?
Oh, yeah. And as you peel apart the numbers, what you saw is that, of course, the July and the August and September numbers prices compared to a year ago are going to be higher. What I'm focused on is that rate of change going up or down. And of course, with fuel prices, they're coming down. But with labor prices, they continue to go up, and they continue to go up, I think, at a very troubling rate. And so for me, the $1 trillion question is this, Neil, is I believe strongly that wages are going to go up, that energy cost is going to come down, the supply chain problems are getting solved, and so you don't have to pay a premium to get a trash compactor. And whether that is going to work out to basically sort of a neutral pricing regime, then I think we are in great shape. And I would nominate Powell to be Man of the Year because he landed this crazy plane. But I'm not sure that's going to be the case.
All right, he has found his Interpol Volcker. He's raising rates fairly aggressively. I think in the last 4 meetings, more than 2 points, right? So at the rate he's going, we'll have a lot higher interest rates by the end of the year. Do you think we'll have inflation under control, more under control by the end of the year?
Yeah, I mean, I would be shocked if we don't have additional rate increases, especially because of this jobs report, and namely what we were talking about earlier, Neil, which is this mismatch between job seekers and jobs available. So I don't see how we're going to get through the end of the year without more rate increases. The question is that really going to make that much of a difference at this point? I mean, if you increase rates by 0.5%, is that going to change consumer behavior in any meaningful way or not to cool down the economy or not?
Professor, and boy, do I wish I had professors like you when I was in college, but I didn't. But I always learn a lot every visit. Thank you, sir. Good seeing you. Have a safe weekend.